Welcome to Buy, Hold, Sell, brought to you by Livewire Markets. My name's James Marlay, and today we're talking about the stocks with some of the highest yields on the market. And joining me to talk about big dividends, Dr. Michael O'Neill from Investors Mutual and Dr. Pete Gardner from income specialist Plato. Peter, I'll start with you. Aurora, looking backwards, big yield, 20%. Looking forwards, buy, hold or a sell?
It's a sell for us. So as you pointed out, the big yield looking back was due to a special dividend they paid in June as a result of the selling of their business. They then cut their dividend substantially in September, and we expect that kind of low level of dividend to continue going forward. So we're expecting around that kind of 4 to 5% yield going forward. But we just think there's a lot of challenges in their business. One of their major customers, Treasury Wines, is undergoing all those problems with China. And so, yeah, we don't think there's too much growth in the business for the price that you're paying.
Okay. Michael, Aurora, buy, hold or a sell?
It's a buy for us. We agree that the yield outlook is about 4.5 to 5%. It's got a very strong balance sheet. There is an ongoing buyback in place. Agree that there are some challenges in some divisions, but the core divisions in packaging, beverage packaging, aluminium cans and glass in Australia and the US, where they're top 2 player in Australia, top 5 player in the US, are very resilient businesses. We think that underpins a very secure and low risk yield.
Okay, staying with you, Centuria Office REIT. We know office been under pressure. Centuria's a good manager, nice yield, buy, hold or a sell?
It's a hold for us. It's trading about 20% discount to NTA. Now we are very cautious on the sector, but when it comes to office REITs, this is one of our preferred ones. And the reason is 75% of their tenants are government or multinationals. So you saw the quality of that tenant base come through in collections through COVID, which bottomed out at 89%. And we've also seen transactions go through which justify their asset value. For instance, their recent sale in Chatswood, which was a 7% premium to book value.
Okay. Peter, Centuria Office REIT, has it got a spot in the portfolio for you guys?
Does. It's a hold for us, very similar to Michael. As you pointed out, it's a challenged industry, but they're one of the better players in the industry, and so we like it. Okay,
staying with you, AGL, buy, hold or a sell, circa 9% yield?
Yeah, it's a sell for us. The business is under real pressure at the moment, not necessarily due to what management's doing, but just because of the overall industry dynamics where electricity wholesale margins are under significant pressure at the moment. We kind of commend the management for trying to move into renewable energy. Obviously, that's the way of the future. However, it's pretty challenging for them to do that given the amount of solar panels that are being installed by individuals on roofs. And so we just think they're in a pretty challenged area at the moment.
Okay. Does an 8% yield spark your interest in AGL?
It's a sell for us too, James. I mean, it's fallen 50% around about in the last year, but those pressures on wholesale electricity prices and growth in renewable supply are not going to go away, and they're also suffering pressure in their retail gas margins.
Okay. The unconventional part of the market for dividends, but they're starting to build up a track record. Fortescue Metals spewing out cash, buy, hold or a sell?
It's a sell for us. Fortescue, as a pure play iron ore producer, has benefited more than the other large listed miners from the growth in the iron ore price from $100 per tonne at the start of the financial year to $160 per tonne. And we look at commodity stocks and we believe they follow commodity prices. So when that supply-demand imbalance in the market corrects, not only are your longer term dividend prospects impaired, but also your capital value is at significant risk.
Yeah. That's the main argument against owning miners for dividends. Is Fortescue a buy, hold or a sell?
It's a buy for us. So we agree with what Michael's saying, but we just think the cycle is going to take a lot longer to play out than people expect. And in terms of what the market's pricing, the market's not pricing prices to stay, iron ore prices to stay up $150 a tonne. Everyone knows they're going to come back. It's just a matter of when. And we think it'll take longer, and so you've got to take advantage of those dividends and good capital returns while they're there.
Okay, well, I guess somewhat related to the boom in commodity prices is Horizon, transport, infrastructure, nice yield over 7%, buy, hold or a sell?
It's a buy for us. It's also been challenged in the last year, mainly through the move away from coal, and particularly after China's kind of export ban on Australian coal. It, of course, transports coal from the mines to the ports, and so it's come under a lot of pressure from that. However, we just think with the amount of coal mines that are coal power plants that are being built in Asia, that'll take a bit longer to play out than people expect, and so the yield is just too high, the value is too good for us to look past it.
All right, do you see the same juicy value in Horizon? Is it a buy, hold or a sell?
It's a buy. Completely agree with everything Peter's said. I mean, the yield's about 7%. 60% of their business is regulated. They do have an ongoing market buyback. 40% is unregulated. The haulage services under 10-year contracts to some of the lowest cost coal producers. Certainly falling coal volumes is not a good thing for Horizon, but there are a lot of mitigating factors under their take-or-pay contracts.
Okay. Well, our two guests don't agree on everything, but one thing is for sure, you're going to find better than 0.1% income if you go looking for some dividends in the equity market. Ladies and gentlemen, in 2021, we're really encouraging you to get more involved in our episodes of Buy, Hold, Sell. And one of the ways that we're doing that is encouraging you to send through the questions that you've got to our experts on the panel. And we've got a couple of reader questions that have come through on income. Peter, I'm going to start with you. I think this is really topical, actually. What impact do you believe the end of the government's job seeker and job keeper packages at the end of March will have on dividends? What are some of the potential things people need to keep an eye on?
Well, there's not too many big listed companies that are going to have a big impact from this unless the economy turns down significantly, I guess. But the biggest one would be the bank area, in that if we see the end of the JobKeeper and a lot of businesses start going broke at that point, I mean, generally when you have a recession, businesses start to go broke towards the end of the recession rather than the beginning, as they hold out as long as they can. However, the government stimuluses have been so significant that we think businesses are probably in a pretty good condition, and unless we have a few kind of significant COVID outbreaks and businesses have to shut down again, that we don't think bad debts are going to be too bad for the banks, and we don't expect it to have too much impact on dividends. Okay, Mike, we've got anything to add to that? I mean, it's been a massive stimulus package. Are there any kind of pitfalls to be aware of, particularly from an income perspective?
Well, just to reiterate what Peter said, I think that March to June period is a critical time for the banks, not only because of job seeker, job keeper, but also because the deferral measures roll off and we finally get to see what's happening in the real economy with the health of SMEs. I guess it's really a question of any sector that's leveraged to increasing unemployment, and that risk looks like that risk is lower than we had expected.
Okay. Last week we shot an episode on small caps. We struggled to find small caps with a decent yield from the ones that we screen the market for. A question, are there any undiscovered small caps, or maybe they are well discovered, that provide a sustainable yield? You've got an example of something or a particular part of the market?
Probably a mid-cap, but Abacus Property Group is one of the REITs that's been left behind, decent yield, decent assets, particularly their storage assets.
Yeah. Same question to you, Peter, something in that small space?
So we really like Adairs at the moment. So it's obviously benefiting from a lot of that furniture spending and otherwise, but it looks on a pretty strong yield at the moment. Their earnings are going up significantly. They've got a really good online channel, which has benefited during COVID. And so we like it at the moment.
Okay, great. Well, thanks very much for sending through your questions. Keep them coming, and we'll be back with our next episodes coming up next week.